I'm Genova, and I'm a manager at Brown Edwards, and Chris Murray is a senior manager at Brown Edwards, and we're going to be presenting on GASB 91 through 93 today. The focus today is going to be on GASB 91, Conduit Debt Obligations. We're going to be talking about GASB 92, Omnibus 2020, and we're going to be talking about GASB 93, Replacement of Interbank Offered Rates. GASB 91, Conduit Debt Obligations, is effective for reporting periods beginning after December 15, 2021. Retroactive application may be applicable. The purpose of GASB 91 is to clarify existing definition of a conduit debt obligation, to establish that conduit debt obligation is not a liability of the issuer. We're going to talk a lot more about that. Establishes standards for accounting and other reporting of commitments and other arrangements, and improved required note disclosures. So let's start from the beginning. What is a conduit debt obligation? GASB 91 lays it out very clearly. Certain limited obligation revenue bonds or similar debt instruments issued by state or local government entity to provide capital financing for a third party. The debt instruments are tax exempt, so that's a big advantage for the third party. Although the debt bears the issuer's name, there's no obligation beyond the resources provided by a lease or loan. So embedded in this definition is a limited commitment on the part of the issuer. There are other types of commitments, but the original definition is limited commitment, and we're going to talk about two other ones in a moment. So who are the three parties in a conduit debt obligation arrangement? The issuer, which is usually a county, a city, or an economic development authority. A third-party obligor, which is usually a developer or maybe a nonprofit. And the third is a debt holder or debt trustee. The third-party obligor is the one who receives the actual proceeds from the debt issuance. They use the debt for projects such as affordable housing developments, not-for-profit hospitals, nursing homes, and economic development projects that are in the public interest. They are primarily obligated for the debt service payment. Because of this unique arrangement, there are restrictions on the debt instruments and the parties involved in this arrangement. So there are two restrictions that need to be considered. One, the instrument can't be a parity bond of the issuer nor cross-collateralized with other debt of the issuer. And second, the issuer and the third party can't be within the same financial reporting unit. In other words, it can't be between a primary government and the component unit. And so let's look at an example from Aspen, Colorado. Aspen, Colorado has an affordable housing nonprofit discrete component unit. So it seems like the ideal candidate to be a third party in a conduit debt obligation arrangement, but it's a component unit that is part of the financial reporting entity of Aspen, Colorado. So those two cannot enter into a conduit debt obligation. The reason for this restriction is because you could end up where the government becomes both the issuer and the third party. And so that's why these restrictions are there. So let's look at a conduit debt note disclosure. This is the current presentation before the implementation of GASB 91. And this is coming from a locality in Kentucky. And so the only evidence of conduit debt obligation in the issuer's financial statements is going to be this note disclosure. You're not going to see anything probably on the balance sheet, for example. And so we're going to walk through this note and take a look at the pieces together, okay? So the locality in Kentucky has issued industrial revenue bonds, which is a very common type of this conduit debt, to provide financial assistance for the acquisition and construction of industrial and commercial facilities deemed to be in the public interest. The bonds are secured by the property, financed, and are payable solely from payments received on the underlying mortgage loans. So that sentence lets us know that there's the kind of lease type arrangement going on here, and we're going to talk more about that in a little bit. Upon repayment of the bonds, ownership of the acquired facilities transfers to the private sector served by the bond issue. So what they're saying in this sentence is that right now, the title of the asset, the ownership of the facilities, is not with the third party during this arrangement, it's with the issuer. So that's something we're going to consider and come back to as well. The government is not obligated in any manner for the repayment of the bonds. There's that limited commitment that's embedded in the definition of a conduit debt arrangement. Accordingly, the bonds are not reported as liabilities in the accompanying financial statements. So again, limited commitment, there's no liability recorded on the issuer's financial statements. And then the note wraps up with saying, as of June 30th, 2020, there are 15 series outstanding with an aggregate amount payable of $56 million. So this is a really great example of a note disclosure, and with a few modifications, it's ready to go for GASB 91 implementation. So this is a locality in Kentucky, but another very, very common issuer is an economic development authority. So let's do a quick attendance question here. Is your locality a conduit debt obligation issuer? In other words, does your locality facilitate bond issuance for a third party, yes or no?
Okay, the first poll is being launched. Closing the poll.
Can you tell us the results?
71% no and 29% yes.
Okay, so we've got a few issuers in the audience then. Conduit debt obligations are not the liability of the issuer, right, according to the definition, or are they? There are situations in which the issuer may be recording a liability. An issuer may extend additional commitments or voluntary commitments to support debt service in the event that the third party is or will be unable to meet the debt service requirements. So additional commitments are pledges or guarantees made at the time of the issuance. So in other words, they're part of the agreement terms. And the additional commitments could be the moral pledge. Usually if affordable housing for public good is part of the project, they may agree to appropriate funds, and they may agree to replenish the debt reserve fund. Voluntary commitments are when the third party is or will be unable, then the locality may decide at that time to honor a voluntary commitment to cover debt service payments or replenish a debt service fund or appropriate funds. The issuer should evaluate this annually and walk through the more likely than not qualitative factors. GASB lays that out in the implementation standard. And then if it's more likely than not, the third party is or will be unable and there is going to be a commitment honored, then the issuer would record a liability. And they would record a liability using the discounted present value of the best estimate of future cash flows. So the more likely than not qualitative factors are, there's 7 here. So is a third party entering into bankruptcy? Are they in breach of debt contract, rate covenants, debt service ratios, defaulting on payments? Are they experiencing significant financial difficulty? Has the project been terminated? Is there litigation that would negatively affect the project? And the 2, which actually on the bottom, but I think they are the most important because it's looking at it from the issuer's perspective, which is what is the issuer's history of fulfilling additional or voluntary commitments? And what is the issuer's ability or willingness to support debt service commitments? So that last one, economic development authorities often are the issuers of these conduit debt arrangements, but they may not have the financial ability to support debt service payments for 1 year, let alone 2, 3, 4 years. So if you are recording a commitment, then here's an example here. You would debit expense, of course, and then you would credit due in 1 year liability, let's say for $3 million. This is just an example. If it's multiple years that you've committed to, then you're going to do credit due in 1 year and then due in more than 1 year liability. You would break the liability up. You would also add 2 paragraphs to the general note disclosure that you would already have. So here's an example that was given by GASB. As a result of excess financial difficulties, the city determined that it's more likely than not that it will honor, describe the type of commitment, replenishing, in this case, the bond reserve fund, and therefore supporting the remaining debt service payments. The amount of the city's liability recognizes the best estimate of the discounted present value of future cash flows. The liability by the city is recognized as follows, and then you include a roll forward. So here's year 1. You're at the end of the year. You think there's going to be a liability that you're going to be honoring next year. So beginning value 0, increase 3 million, no decreases yet, and end of year 3 million. And so you would use that roll forward in the note disclosure until no longer necessary. Well, we talked about liability, possibly recording a liability, but what about an asset? Should you be recording an asset on your balance sheet? You might be recording an asset in a lease type arrangement. So conduit debt used for construction of capital assets, whereby the issuer retains title to the asset and the third-party payments are to cover the debt service. This is a lease type arrangement. It's lease-ish, but don't record it as a lease. So let's walk through a couple scenarios and see what the outcome is as to whether you record an asset or a liability. So scenario 1, title does pass to the third party when debt is paid. This is the example that we looked at earlier from Kentucky. Do not record asset or liability because it's going to pass to the third party. Scenario number 2, title does not pass to the third party, but the third party has exclusive use of the asset during the arrangement. So this is analyzing who has title to the assets and whether there's exclusive use of the asset. GASB gets into whether there's sort of partial exclusiveness going on, but we're going to just stick with exclusive, not exclusive. The issuer in scenario number 2 should not recognize a capital asset on the balance sheet until the arrangement ends. So at the time of the arrangement is established, do not record an asset or liability. Scenario 3 is title does not pass to the third party and the third party does not have exclusive use of the asset during the arrangement. In scenario number 3, then, the issuer should recognize a capital asset and an offsetting deferred inflow of resources. So in scenario 2 or 3, you could have a situation in which you will need, with the implementation of GASB 91, to do a restatement and a disclosure. So here's what GASB 91 would like to see in the note disclosure going forward. General description of conduit debt obligations, like we saw in the example of Kentucky. But then the description should be broken down by each type of commitment. So if you've got limited commitment, voluntary commitment, additional commitments going on, they want that broken out. Outstanding principal payments aggregated by type of commitment. And then if you've got a liability for additional or voluntary commitment, you want to disclose that, explain the terms that we looked at an example of, and include, like I showed you earlier, a liability roll forward. So just for fun, I'm doing year 2 here, roll forward, so you can see what the year 2 would look like. So year 1, you booked the 3 million. You've now paid 1 million of principal payments, so that's in the decrease column. And that increase column is picking up the change for the next year in the present value. And that's how you end up with an ending year balance of 2 million. So if you are going to have to do some implementation, you may be restating all prior periods presented. There's an out if restatement of prior periods is not practical. And in the first year of implementation, of course, notes should disclose the nature and effect of the statement. So no surprises there in terms of how you would handle the recording of an asset or liability on your books if needed. So I'll pause here and see if there are any questions related to GASB 91. Alexa, are there any questions?
And I have not seen any come through, but if there are any, please submit them through the questions feature and I will read them out to you if they come in.
Okay. In the meantime, I think I'll move on to GASB 92 because I know you're all very excited about that. So GASB 92, it was issued in January 2020, covers 8 topics, and the purpose is greater comparability in reporting information and improving consistency of authoritative literature. So big picture, what GASB 92 is kind of a hodgepodge of clarifications, more specific references, and taking specific situations and saying, hey, here's where you would go to look for these things. So topic number 1 for GASB 92 deals with GASB 87 leases. It changed the effective date, but as you are all probably keenly aware, GASB 95 then changed it again so that GASB 87 implementation is for fiscal years beginning after June 15th. I'm sure you all know that GASB 87 is coming. Topics 2 through 4 are related to pension and other post-employment benefits. So sort of high level, what GASB 92 is going to do for topics 2 through 4 is it says, hey, in the last several years, we've implemented 68 and 75, 67, 74 if you're dealing with trusts with independent financial reports. And we now have also GASB 84. So what they did is they said, let's bring these together. Let's polish up the references to specific paragraphs and situations. And so topic 2 then is dealing with inter-entity transfers of financial capital assets within the same financial reporting entity. So the key terms here are defined benefit plans, difference between amounts paid by the plan and the carrying value of the assets. And what they're saying here is look at GASB 68 and 75 or 67, 74 as opposed to GASB 48. GASB topic 3 is reporting assets accumulated for post-employment benefits. Key terms here, dealing with assets, defined benefit trusts, not administered through a trust. And it's saying if you're following GASB 84, that requires the reporting of assets accumulated, not administered through a trust, then follow specific paragraphs that they identify in GASB 73 and 74. Again, cleaning up references and language. Topic 4, defined contribution plans clarification. Key terms, assets, defined contribution plans, not administered through a trust, fiduciary activity. So for this topic, what it's saying is that you need to look at GASB 84, which says that a locality should record a liability when there's an event compelling the locality to disperse fiduciary resources. And so if you have these key terms, then you want to be looking at guidance from GASB 84. And so it's just cleaning up some references and some language. And so now I'll hand it over to Chris Murray to talk about the remaining topics.
All right, thanks, Ann. Good morning, everyone. As Ann mentioned earlier, I'm Chris Murray, and I'm a senior manager out of our Lynchburg office. So for the rest of this session, I'm going to cover the remaining topics of GASB 92 and then walk you through statement number 93. So picking up with topic number 5 of GASB 92, this topic deals with the measurement of liabilities or assets, if there are any, related to the asset retirement obligations known as AROs in a government acquisition. So going back to GASB 69 regarding government combination and disposal of government operations, there are exceptions to the use of acquisition value for acquired solid waste landfill and pollution remediation during government acquisition. Of course, the argument there is that the measurements that are based on current costs and expectations are more relevant for pollution and landfill obligations because there's a logical relationship between the liability and the factors upon which the obligation is based. It was brought to the board's attention, though, that similar exceptions were not provided for AROs when Statement 83 was issued. After considering the implications of this form of exception, the board agreed that the basic requirements for the measurement of certain AROs in Statement 83 are similar to the basic requirements for measurement of solid waste landfill closure and post-closure care cost and the obligation of pollution remediation. So many of the same basic principles, including the measurement of liabilities at the current value of expected outlays, also is used in the measurement of AROs. So as a result, it was decided an exception to the use of acquisition value should be applied to government acquisitions of asset retirement obligations. Moving on to topic 6, which clarifies reporting by public entity risk pools for amounts that are recoverable from reinsurers or excess insurers. Risk pools being governmental entities joining together to finance an exposure, liability, or risk, which may include property and liability, workers' comp, etc. The reinsurer is the insurer passing policies to another insurance company to reduce the risk of claims being paid out. So it's basically the insurance for the insurance companies. So excess insurers cover claims after the primary insurance limit has been exhausted or used up. So excess insurance to transfer risk of aggregate losses above a certain dollar amount. GASB 92 explains that GASB 10 in paragraph 37 that says that recoveries from reinsurers or excess insurers should be reported as a reduction of expenses, which is interpreted by most as required. But then the last sentence says that recoveries may be netted. So they're removing that required reduction of expenses language to reduce the inconsistency without actually changing the practice that most governments apply. So in summary, they're backing off that required language. So topic 7 is pretty simple and straightforward. It relates to GASB 72 on fair value measurements and referencing non-recurring and recurring fair value measurements of assets. It simply corrects the paragraph reference as the reference was not to the correct example that they intended, so that no change to the actual interpretation of the standard. Finally, on GASB 92, we have topic 8, which is simply terminology corrections. Instead of using the words derivative or derivatives, it now uses derivative instrument or instruments, so pretty simple there. As far as effective date, there are a couple of effective dates with GASB 92. The changes related to reinsurance recoveries and terminology used to refer to derivative instruments is effective upon the issuance. The remaining changes and requirements are effective for fiscal years beginning after June 15th, 2021. So that covers the 8 topics of GASB 92, and now I'll move on to the next standard, which will impact most. However, we hope it won't have a significant impact or create too many headaches. That standard is GASB 93, which is the replacement of interbank offered rates, which was issued back in April of 2020. You may be thinking, oh no, we got to listen to for 15 minutes about interest rates, but the history behind the standard is actually pretty interesting in my opinion. I'm sure at times we wonder if these new standards are just simply to create more work for all of us, but I don't think that's the case for creating this new standard here. So after the year postponement due to the pandemic, the portions of GASB 93 related to removal of LIBOR as an appropriate benchmark interest rate, its effective reporting periods ending after December 15th, 2022. And all other requirements of the statement are effective for reporting periods beginning after June 15th, 2021. So this upcoming year for the majority of June 30 year ends. So before we get too far into the standard, we'll launch our second attendance question.
Launching the poll.
That question is, LIBOR is the benchmark for approximately what dollar amount of financial contracts around the world? Is it 250 million, 750 million, 350 trillion, or 750 trillion?
Closing the poll.
All right. So it looks like either y'all looked ahead on the slides or did your homework or just went with the default of always pick and C if you don't know. So the correct answer is C, $350 trillion. Now to get into this standard, it has sort of flown under the radar for many years, but rate fixing and fraud during the Great Recession, dating all the way back to 2008, really set things into motion. So it's not a standard that only relates to GASB, but has a global impact. As a result, it's been addressed by the Financial Accounting Standards Board as well as international standards. So to explain a little history behind this, there was a major fraud and price fixing going on. So the price fixing occurred between the banks in London to set the rate that we know as LIBOR, or London Interbank Offered Rate. Multiple banks were colluding to manipulate the LIBOR rates for their benefit and their profit. After the issues were discovered, the banks of the world, including the Federal Reserve, got together to better regulate the setting of interest rates by commercial banks. That eventually led to the decision to terminate LIBOR in 2017, but realized it wasn't some simple switch considering the amount of contracts and money around the world that is tied to this rate. So you could probably think of all the possibilities, whether it's your personal mortgage or whether you had derivative instruments or leases tied to this rate. And just from our polling question, the last estimate I saw was LIBOR is a benchmark for over $350 trillion around the world. So progress was being made in pushing forward towards an implementation date, and then the next hurdle happened, which was the pandemic. So now GASB 93 applies to contracts involving LIBOR is supposed to end after June 15, 2021. So entering any new agreements, swaps, etc., they should have ceased to referencing LIBOR. Now, I haven't dove into any new agreements this year yet, but I'm sure you're all seeing this at your localities. I'm sure LIBOR will not completely vanish or drop dead on a certain date. However, the latest update I read was that while LIBOR will no longer be used to price new loans in 2022, it will formally stick around to at least 2023. But the 1 week and 2 month LIBOR ceased to being published back at the end of 21, while the overnight 1 month, 3 month, 6 month, and even the 12-month maturities will continue to be published through June of 2023. So after all of this, where do we land on the new alternatives? The result was the U.S. Alternative Reference Rate Committee recommending the SOFR rate, which is the Secured Overnight Financing Rate. Federal Reserve began publishing this rate in April of 2018. The reason being this is a risk-free rate, and as a result, they're calculated and not susceptible to being manipulated. In 2019, the SEC emphasized the need for a widely adopted rate to smooth the transition, and as a result, in 2020, the FASB issued their standard on reference rate reform. So to sort of wrap up the main difference between LIBOR and SOFR, so LIBOR is based on a panel bank input, while SOFR is a broad measure of the cost of borrowing cash overnight collateralized by the U.S. Treasury securities. So that brings us to 93. With their defined objective is to address the accounting and financial reporting effects that result from the replacement of IBORs with other reference rates in order to preserve the reliability, relevance, consistency, and comparability of reported information. Also, they want to make sure we minimize the impact of transitioning from LIBOR. So looking at the impact when considering GASB 53, which is standard on derivative instruments, that standard says when you change your rate, then you're required to terminate the hedge. So for instance, your swap is tied to LIBOR and now you're transitioning to SOFR or some alternative. Now what am I supposed to do about my swap? Another standard is GASB, the GASB want to consider was GASB 87 on leases, which we've, as noted, have heard about for years. That standard notes that changing the discount rate requires you to revalue your underlying liability and related asset. So now you have the potential for outstanding notes, derivative instruments, leases, all tied to LIBOR. So it's a potential to be a large task to undertake addressing all these different changes. However, the goal of the GASB was not to create all this rework, because years back, governments had no idea that tying their instruments to LIBOR, that the LIBOR would eventually disappear or go away. So now, the next several slides are a little more heavy with technical definitions, but I didn't want to lose anything that was actually in the standard. I know our eyes can kind of glaze over and when we start hearing terms like hedges and swaps and derivatives, but I promise I'll give you the Cliff Notes version of the plain English version after each definition. So to continue with the goal of seamless transition when it comes to hedging instruments, so your swaps, etc., GASB 93 has created some exceptions to hedge termination. The standard states that you should continue to apply hedge accounting to a hedging derivative instrument when the reference rate of the original hedging derivative instrument's variable payment is an IBOR if all of the following criteria are met. 1, the hedging derivative instrument is amended or replaced to change the reference rate of the variable payment or to add or change fallback provisions related to the reference rate of the variable payment. So essentially, an agreement was reached to change the rate used in the derivative calculation. In addition, the reference rate of the amended or replacement variable payment essentially equates the reference rate of the original variable payment by one or both of the following methods. So how do we make the old rate equal the new rate? The first being that the rate already equals the original rate, or a coefficient is agreed to apply to the addition or subtraction so it equals the original rate, or the parties come to an agreement to an upfront payment being made. Once again, the amount of the payment is limited to what is necessary to essentially equate the replacement rate and the original rate. If the upfront payment is made or received, then that payment should be reported as an asset or a liability and amortized over the duration of the hedging instrument. So ultimately, the goal here is that SOFR or whatever alternative rate is chosen that is agreed to if it isn't comparable to LIBOR, then a coefficient or upfront payment is used to make each party whole again. Let's see here. So finishing up the exceptions, they're in place for terminating the hedge. The replacement or reference rate puts in place the ending of the original hedging derivative instrument and entering into a replacement hedging derivative instrument. Those transactions must occur on the same date. So in plain English, even if the agreement notes termination, then it's not to be treated as a hedge termination as long as you entered it on the same date. Finally, there may be some term changes that are allowed without actually terminating the hedge. So what are those allowed term changes? First, you have the frequency with which the rates of the variable payments reset. Next, you have the dates on which the rate resets. Also, you have the methodology for resetting the rate. And finally, the dates on which periodic payments are made. So essentially, if you're making adjustments to the terms, and these are the areas that those terms are changing, then you're just continuing the agreement that you're already in. So all of these exceptions boil down to there are exceptions in place to structure the agreements to avoid adjustments to your financial statements. So earlier we talked about that SOFR rate that was established back in 2018. So if you're transitioning to that SOFR rate, then it may be done in a two-step process. The first step is amending or replacing a hedging derivative instrument to change an IBOR to a new rate other than the SOFR rate, and then the second step being subsequently amending or replacing that new rate to the SOFR rate. The fact of it being a two-step process does not impact the treatment as long as all the previous exceptions defined were met. Now, when I first read this, I couldn't quite grasp why somebody would want to add steps to this transition, but they expanded, noting that some governments proactively change from IBOR to the effective federal funds rate or swap index until subsequently transitioning to SOFR. The board did not want to significantly impede the anticipated market-wide shift to the SOFR, which resulted in the exception for the two-step process. The board noted that many governments were not immediately transitioning to SOFR until liquidity in the SOFR market was growing. So this appears to be the reaction that most would have to anything that's new, which is trying to trust the reliability of that new rate before making any change. Next, on the appropriate benchmarks, the standard defines what is considered an appropriate benchmark interest rate, and define that the interest rate on direct treasury obligations of the U.S. government, the effective federal funds rate, known as EFFR, or the SOFR. In the same section of the standard, it went on to repeat that LIBOR is not an appropriate benchmark interest rate for derivative instruments that hedges the interest rate of taxable debt. Finally, GASB does update the definition of what a reference rate is. The important piece here is that the reference rate examples are removed. So previously it listed LIBOR, etc. as examples, but those have now been removed. Now, when it comes to leases, the standard is pretty short and sweet. Changing the index rate upon which variable payments depend for a lease is considered a lease amendment. However, if variable payments of a lease contract depend on an IBOR, an amendment to the contract solely to replace the IBOR with another rate, of course, that is adjusted as necessary to essentially equate the replacement rate and the original rate, by either changing the rate or adding or changing fallback provisions related to the rate, this will not be considered a lease modification. So once again, it's the same terminology used earlier on the hedging, and the key is establishing an agreement on a comparable rate to avoid revaluing that lease. And now we'll launch our third and final polling question for this session. That question is, have you had any communications with financial institutions or insurers or issued any new contracts that transition from LIBOR? Would you say yes, no, not sure, my department doesn't handle that, or I don't know, I'm just an auditor?
Launching the poll. And Chris, we did have a question come in, so I'll read that out after I share the results.
All right.
Closing the poll.
All right, so it looks like we got a very small percentage that have actually talked with that institution about LIBOR. So I guess we'll see how that plays out as far as banks reaching out or localities being the first to reach out on these changes. Alexa,
Okay.
you say, go ahead.
Yes, the question is, so for GASB 87 and leases, if I only lease, for example, a copier, however, I am not leasing to own, therefore it is technically not an asset for me, as if I do not plan to renew my contract with the vendor, therefore they take away the equipment. Does this apply to the new lease for GASB?
I think I'll have to actually do some research on the actual lease side of it as opposed to. Yeah, I think it's probably best just I'll get the question and actually be able to read it and research that, and we'll just get back with them after the presentation, I think. All right. So wrapping up this standard, As we had hoped, the board considers the cost and benefits to any new standard. The board notes that with the exceptions in place for hedge accounting and lease modifications that we went over, it does not affect the probability that a transaction will occur. It will reduce the cost for governments and facilitate government's transition away from IBORs. With these exceptions, the likelihood of a transaction is reduced, which preserves the consistency and comparability of your financial statements. In other words, comparability remains intact when you're able to avoid restatement. Now, if you're unable to fit into one of the exceptions we discussed for derivatives or leases, then the standard defines that the changes adopted should be applied retroactively by restating the financial statements if practicable for all periods presented. Unfortunately, inconvenience is not the same as impracticable. But if restatements for prior period is not practicable, the cumulative effect, if any, of applying the restatement should be reported as a restatement of beginning net position for the earliest period restated. In conclusion, when trying to think of some of the concerns you may have, the first being, what should I be doing now? First, evaluating what contracts you have that are tied to LIBOR, and then communicating with financial institutions regarding their plan to adjust to LIBOR going away. Once this communication begins, then being aware of those exception provisions that are there for structuring the amendment changes and amendments. As far as what us auditors would want to see and know, we want to know what modifications were made and the conclusion on the accounting impact. And I'm sure your auditors would be available early in the process if you think you're going to fall outside of one of those exceptions. As far as the impact on your financials and disclosures, we discussed the requirements for retroactive restatement. However, without a triggering transaction, there's a potential for no impact outside of updating the disclosed terms of the contract. So for instance, at some point, your notes won't be referring to interest rates being at LIBOR anymore. So that concludes the summary we have on GASB's 91 through 93.